PLCs explained. For many Irish farmers, there are two options when deciding how to operate a farm as a business. One can identify as a sole trader or a private limited company, both having distinctions for financial reasons. Many larger scale farming enterprises are switching their farm to a company status or as a PLC. Many Irish farmers may be contemplating what a PLC actually looks like and what it might mean for a farmer's financial year. Not that we have a financial advisor and retainer, but it might be a helpful way to look at the pros and cons of switching to company status. It might be best to start with simple definitions of both types of businesses. Where you decide to operate as a sole trader whilst a farmer, you make the decision to run the business yourself. The incoming profits of the business belong to you, and you are personally responsible for any debts or liabilities that the business incurs. In contrast, turning your farm into a company, also known as incorporation, essentially means that the burden of repaying debt is limited to the company shareholders. In other words, should the company become insolvent, the shareholders will only have to repay the amount they invested into the company, as opposed to being personally liable and having personal assets seized. This can be crucial for farmers, as often they are the company and hold all the shares. A PLC is a separate legal entity. The company becomes the farmer, business profits belong to the company first, the company will have its own bank account, and all business expenses are invoiced to the company. In the farming sector, the limited company structure is predominantly found in large, profitable farms at the moment. With this, the farmer assumes many roles at once. The farmer becomes simultaneously a shareholder, director, lender, landlord, and employee. So you might still be asking what the real difference between a sole trader and PLC is. Well, it all really boils down to tax implications. The biggest difference between operating a business as a limited company and operating as a sole trader is the rate at which tax is paid on those profits. With corporation tax still resting at 12.5%, by comparison with the higher band tax rate of upwards of 50%, it is certainly worth any farmer's time considering the pros and cons of changing your business status. In recent years, operating a farm business as a limited company has certainly become an option for dairy farmers, as well as larger tillage and dry stock farmers. Incorporation, or forming a private limited company, can provide farmers with an opportunity to plan and manage taxes more efficiently, but succession and finances are the critical issues to consider. The reasons for farmers setting up a company vary, but may include the following. Number 1. If they are paying tax at the higher rate, tax and levies up to 55% compared to 12.5% in the company. Number 2. If they wish to build up cash to develop the farm, buy land, or contribute to a pension. Those with high debt levels may find the higher rate of tax payable on capital repayments leaves them with very little spare cash. And number 3. If they are unable to opt for income averaging as their spouse is self-employed in a non-farming business. However, it should be noted that incorporation does have some consequences for successors, and these must be considered also. For instance, farmers must note that farmland registered as a company may not be regarded as an agricultural asset and subsequently may not qualify for agricultural relief in respect of gifts and inheritance. If a farmer plans to retire in the near future, incorporation may not be a viable option. So these are the pros and cons of moving to a PLC type of business. But with the trend of farms increasing in size and turnover, it may be a business style that more and more farmers adopt.